Solar power company Sunrun is down 82% from its all-time high, but the stock has more than doubled since November. At the current price, Sunrun has a market cap of $4 billion, account for cash and debt, and the enterprise value is $4.6 billion. Revenue over the last 12 months is $2.4 billion, but the company is not currently profitable. Net income over the last 12 months is minus $1.2 billion, and free cash flow is minus $380 million. The bull case for companies like Sunrun is relatively simple. Demand for solar power should have years, if not decades, of growth ahead. Meanwhile, government subsidies are providing a raft of tax credits and cheap financing. It's this combination that has helped Sunrun grow its revenues from $500 million in 2016 to $2.4 billion today. However, a typical rooftop solar system can cost between $25,000 to $45,000. This high cost usually requires financing, so higher interest rates this year have caused a significant decrease in demand for residential solar. In addition, changes to policy in California have sharply reduced payment for solar energy that's sent back to the grid. This is significant because the Golden State makes up 38% of residential solar in the US. With this backdrop, it's not surprising that Sunrun's revenue growth has dropped sharply this year to under 10%. Meanwhile, it's worth mentioning some other forces at play. Sunrun appears unprofitable now because it funds new solar systems up front with the expectation that it will earn back that investment over time. It therefore measures its business not on current earnings but on cash flows way out in the future. Based on that metric, the company can succeed so long as it maintains funding from its investment partners. However, short interest on Sunrun stock is over 20% because some investors don't believe in that model. Short seller Muddy Waters has accused Sunrun of underestimating future maintenance costs, while overestimating tax credits and subscriber numbers. As such, it says Sunrun executives have some explaining to do. More broadly, an article in Forbes claims the entire industry is operating on shaky footing. In October, solar financing business Sunlight Financial declared bankruptcy, and 2 days later, Sunrun ended up writing off $1.2 billion of its investment in Vivint Solar. One hedge fund manager called the residential solar industry a debt Ponzi, similar to the subprime mortgage crisis. Overall, this is a difficult story to understand because so much of the value that will be created, if any, comes from years out in the future. Estimating future cash flows involves a great deal of uncertainty, and with the era of cheap money seemingly over, it's not clear where Sunrun stock will go from here. That's why it's best to avoid this stock, but these are my personal opinions, not financial advice, and I've got no position in Sunrun. For more investing videos, make sure to visit my website, 3minutebreakdowns.com. Thank you for watching.